Hello and welcome to another session, Mortgage Banking Value Chain. Mortgage banking involves basically three major areas of activities. The first one is loan production, second one is secondary marketing and servicing. Each of these activities is normally performed in a separate unit or a department of the bank or mortgage banking company itself. So the loan production unit basically it originates the loan and processes it, underwrites it, and it closes the mortgage loan. The secondary marketing unit develops prices and sells the loan product and delivers loans to a permanent investors. Also, it is responsible for the pipeline and warehouse management, which involves managing the price risk from the loan commitments and the loans held for sale. So what does the servicing does? The servicing unit, sometimes which is referred to as loan administration, collects monthly payments from the borrowers, remits the payments to the permanent investor or the security holder, handles the contacts with the borrowers about the delinquencies, assumptions, and the escrow accounts, and pays the real estate tax and insurance premiums as they become due. So each of this segment has been broken down further as per their functionality. Okay, so now let's understand what each segment mean and what all the different activities, what exactly the process is involved in each segment. First one is loan production. So loan production, basically it involves loan origination, loan processing, loan underwriting, and the loan closing. Okay, so these are the four main processes which are involved in the loan production activity. First one is loan origination. So this particular stage broadly consists of two set of activities. First one is pre-qualification. So what exactly pre-qualification? Pre-qualification process is based on estimating the affordability of the borrower for the mortgage payment, whether this borrower is capable of making the monthly payment for the mortgage he or she is going to take. Disclosure generation. So according to the federal government guidelines, a set of disclosure documents need to be generated and sent to the borrower once the borrower agrees to apply for the loan from the lender. So these documents typically are like good faith estimate, which is called as GFE doc, TILA, which is called Truth in Lending Act document or Truth in Lending document, and servicing disclosure statement, whom the mortgage would be serviced by. And in the loan production, again, there is a second process called as loan processing. So loan processing is basically like, it basically consists of four major activities. First one is verification of the income, employment and financials, earning statements, profit and loss statements if any borrower is having, and the tax returns for the current year and previous 2 years documents for the social security, overtime bonus, commission, interest income, veteran benefits, etc. is also verified. So the verification of the income and employment and financial are done at the stage of loan processing. Property appraisal. What exactly is the property appraisal? An appraisal is an estimate of the value of the property made by a qualified professional called as an appraiser. What does appraiser does is he would go and look at the property and he would appraise the property for the current market value. Credit scoring. Ordering of the credit reports for the borrower from the credit reporting agencies. So the credit scoring, it's ordering of the credit reports from the borrowers. Title search. A title search is a detailed examination of historical records concerning a property. Loan underwriting. So this is the third stage within the loan production, which is called as loan underwriting. This is a very critical area of loan processing or loan production. This stage broadly consists of three major activities. First one is evaluation of 3 C's, which is called evaluation of credit, collateral, and capacity. So in this, actually, the underwriter is going to perform how much total credit liability would be there, and what is the total asset he is having, what is the total monthly income. So we are going to discuss all about this in details in the later sessions. Validation and review of the borrower information details. So basically, the loan underwriter does a second level of review and validation of all the documents to verify that information supplied by a mortgage applicant, such as the income, employment, and down payment sources, are really, genuine or other really from the borrower or not. So loan repricing. So the loan parameters will be checked against the guidelines provided by the private investors or the GSE, that is government sponsored entities, to arrive at various loan pricing scenarios. And the fourth section within the loan production is loan closing. This stage broadly consists of three setup activities. First one is loan funding. The closing agent will make sure that all the necessary papers are assigned and recorded, and that funds are properly disbursed and accounted for when the closing is completed. Basically, it takes care of the funding, which is basically the lender is providing to the borrower, which basically disbursed to the either borrower account or homeowner's account. Loan documentation and delivery. Loan closings may be performed by an internal loan closing unit or by the title companies or the attorneys acting as the agents for the bank. Okay, so the third thing which happens in the loan closing is post-funding quality control. The government established the institutions like HUD, Housing and Urban Development Authority, Freddie Mac and Fannie Mae, and most private investors require the lender to have a quality control unit that independently assess the quality of the loans originated or purchased. All right. So second second stage in the mortgage banking value chain is loan servicing. What exactly is the loan servicing? So loan servicing is basically refers to the part of the value chain starting from the closure of the loan. Basically, it starts from when the loan is getting funded and closed until it is fully repaid and settled. So it includes activities such as the periodic payments management, accounting, investor reporting, customer servicing, and records management, etc. So loan servicing consists of following major activities. There are several other activities, but following are the major activities which are happening in the loan servicing. So basically, the cash management, investor accounting and reporting, document custodianship, escrow account administration, delinquency management, customer service. So these are some of the the important functions which happens during the loan servicing process. What is cash management basically? If you look at one of the functions of the loan servicing, you can see the cash management is one of the important within the loan servicing. Cash management basically it consists of collecting the borrower's mortgage payments and depositing those funds into custodial accounts. So the mortgage payment consists of principal, interest, taxes, and insurance, which is short named as PITI. The principal and the interest portion of each payment is separated from the portion set aside the escrow items, which is meant for the insurance and taxes. These custodial accounts require daily balancing and monthly reconciliation, control over the disbursement and the deposit of the funds into the appropriate financial institutions. Investor accounting and reporting. So investor accounting and reporting consists of performing the various record keeping functions on behalf of the investors. Document custodianship. In this function, basically, the servicer is responsible for ensuring collateral documents are obtained and released for the loan servicer portfolio. A servicer may himself be involved in the document custodianship or may outsource it to a third-party agency. Escrow account administration. Escrow account administration. Basically, during the escrow analysis, the lender reviews escrow account and determines if it is adequate to cover the fees for the insurance, taxes, and any other premiums paid through the escrow. If the amount is found to be insufficient, the lender may ask to increase regular monthly payment. If it is a new services policy to review the escrow accounts as soon as the servicing is transferred, payment may change immediately. The borrower should receive an explanation regarding any of these changes. Delinquency management. So what exactly the delinquency management? Delinquency management is basically refers to default management. If borrower goes on a default, then it has to be managed by the servicer. So it is called as default management, which includes basically the tracking and reporting the status of the loans. There are in various stages of the default. Again, the default management, there are it's again a big topic where the loans once they've gone into default, it becomes 30-day delinquency, 60-day delinquency, and 90 days, and then it goes to the foreclosure and it goes to the auction. Default management itself is a very big topic. Okay, what is secondary marketing? Okay, so bank raises deposits, okay, and use that money to provide the loans and the mortgages. So the ability of the bank to provide the loans is limited by the extent to which it can raise deposits. Okay, so how much ever you raise as a deposit, that much only you can give it as a loan. This on an aggregate scale also limits the total demand that the mortgage market can manage. So in order to increase this limit, the secondary market basically evolved. Unlike the primary market, which concerns all the processes required to bring a mortgage into existence, the secondary mortgage market is the portion of the mortgage market in which the lenders, government-sponsored agencies, private conduits, and the investor buy, sell, and trade existing mortgages. This market serves as an outlet to sell the originated loans to help to generate funds for the continued lending. For the home buyer, the secondary market makes funds and a wide array of financing alternative available. For the lender, it can increase the profits and help reduce the risk of mortgage lending by making available a liquid market for the mortgages. So secondary market basically consists of different processes. First one is loan sales. Sell all loans, participations, and mortgage-backed securities. A bank's secondary marketing department working with the production management is responsible for developing, pricing, selling, documenting, and delivering the mortgage products to the investors. A bank must consistently demonstrate reliable performance in underwriting, documenting, packaging, and delivering the quality mortgage products to remain in the good standing with the secondary market participants. So the poor performance of the loans sold could lead to unfavorable prices for the future sales or terminated relationship with the banks. What is pricing? Price loans in the correlation to ever-changing market forces so that the company produces value from the loan it basically produces. Pipeline management. Keep track of the warehouse line limits and the requirements using the pipeline reports. Estimate how many loans will close, when they will close, and how the company will fund those closings. Risk management. Monitor and manage the risk in the mortgage market, such as the interest rate fluctuation. If any changes is going to happen in the interest rate, so it's going to affect the cash inflow for the secondary market investors. That's why risk management also has to be done by the secondary market players. Shipping and delivery. So preparing and delivering the documents to investors as quickly as possible to avoid the interest rate risk, to meet the commitments and release the warehouse line for the new lending. So this is all done in the secondary market. All right, this makes the end of all the chapters in learning basics of the mortgage banking. So there are several key terms and concepts in the mortgage banking. I have attached those in the Excel file and uploaded as resources to this lecture. Please feel free to go through those terms and concepts that will help you in next part of the course, where all these topics are discussed in details, because since it is the basic, this module is dedicated for understanding the basics of the mortgage banking. I did not go in details of every other subtopics, but if you go through all these key terms and concepts which I have given in the Excel spreadsheet, that will help you to understand the later sessions very easily. Having said that, bye for now and see you in the next set of lessons. Thank you.